Amazon entered 2026 with mixed signals, its stock trailing the S&P 500 last year, yet analysts still call it a strong buy. With AWS powering global AI infrastructure, advertising revenue surging, and billions poured into future growth, the question is clear: is Amazon undervalued today, or is Wall Street overestimating its next chapter? Amazon is no longer just the world's largest online retailer, it has evolved into a diversified technology powerhouse. With a market capitalization approaching $2.5 trillion, Amazon's business spans e-commerce, cloud computing through AWS, digital advertising, logistics, and now artificial intelligence infrastructure. In 2025, the company generated over $180 billion in quarterly revenue, with AWS growing at 20% year-over-year and advertising surging 24% to $17.7 billion. These segments, once considered side businesses, now drive profitability and innovation. For more than 3 decades, Amazon has disrupted industries, from retail and logistics to cloud and streaming, and in 2026, it stands at a pivotal crossroads. Its massive $200 billion capital expenditure cycle, including a bold bet on AI infrastructure, signals a future where Amazon is not only the backbone of global commerce but also a central player in the race for generative AI dominance. Despite regulatory challenges and rising competition, Amazon's scale, brand power, and diversified growth engines remain its strongest assets, anchoring its leadership in the global tech ecosystem. In today's market, Amazon remains a global heavyweight, but its role has shifted. Within the Magnificent Seven tech giants, Amazon was the weakest performer in 2025, delivering only about 5% growth compared to the S&P 500's 16%. Yet, its dominance in e-commerce and cloud computing is unmatched. AWS continues to lead the global cloud market, competing head-to-head with Microsoft Azure and Google Cloud, while Amazon's advertising business has quietly become a profit engine, growing faster than retail. Despite short-term underperformance, Amazon's scale and diversification keep it firmly positioned as a cornerstone of the digital economy. Its logistics network underpins global commerce, AWS powers enterprise innovation, and its AI infrastructure investments aim to secure leadership in the next wave of technology. In 2026, Amazon is not just competing, it is defending its place as both a market incumbent and a future shaper in the tech ecosystem. Amazon's fourth quarter of 2025 highlighted both resilience and investor concern. Net sales climbed to $213.4 billion, a 14% increase from the prior year, with North America up 10% and international markets up 17%. The real standout was AWS, which surged 24% year-over-year to $35.6 billion, reaffirming its role as Amazon's most profitable engine. Advertising also continued its rapid ascent, cementing itself as a critical growth driver. Yet, despite these strong fundamentals, Amazon's stock dropped nearly 8% after earnings. The reason wasn't weak revenue, it was the company's bold forecast of $200 billion in capital expenditures for 2026, aimed at securing leadership in artificial intelligence and cloud infrastructure. For investors, this raised questions. Will Amazon's aggressive spending deliver future dominance, or weigh down near-term profitability? In short, Amazon's recent performance shows a company still expanding across its core businesses, but facing scrutiny as it invests heavily in the technologies that could define its next decade. Amazon's growth story in 2026 is defined by 3 powerful engines. First, AWS has re-accelerated, moving from 20% growth in late 2025 to projections of over 30% revenue growth this year. This surge is tied directly to Amazon's massive investment in AI infrastructure, over $125 billion in 2025, with additional federal support in 2026. Analysts estimate that each gigawatt of new AWS capacity could generate billions in incremental revenue, making cloud and AI the centerpiece of Amazon's future earnings power. Second, Amazon's advertising business has quietly become a profit machine, now exceeding $60 billion annually. With its unmatched reach across e-commerce and streaming platforms, advertising delivers higher margins than retail and is increasingly viewed as Amazon's hidden gem. Third, the company's Prime membership base has surpassed 240 million globally, reinforcing its ecosystem advantage. Prime is more than just free shipping, it's a gateway into Amazon's marketplace, streaming, and exclusive services, creating sticky customer relationships that competitors struggle to replicate. Together, these growth drivers, cloud and AI, advertising, and Prime, illustrate how Amazon is evolving beyond retail into a diversified technology platform. While heavy capital spending may weigh on near-term profits, these investments are designed to secure Amazon's leadership in the next wave of digital transformation. Now we are looking at a small portion of Amazon's financial ratios for fiscal years 2025 and 2024. Let's begin with fiscal year 2025. Amazon reported a gross margin of 50.29%, meaning that from every $100 of revenue, about $50 remained after covering the direct costs of goods and services. This was slightly higher than the 48.85% margin in 2024, showing improved efficiency in operations and pricing power. Return on invested capital, or ROIC, stood at 15.49% in 2025, compared to 15.19% in 2024. This ratio tells us how effectively Amazon generated profit from the capital it deployed. The improvement, though modest, indicates stronger profitability relative to resources invested. Moving to free cash flow margin, Amazon posted 3.86% in 2025, down from 7.59% in 2024. In simple terms, from every $100 of revenue, only about $4 turned into free cash flow in 2025, compared to $8 the year before. This decline reflects heavier capital expenditures, especially in AI and cloud infrastructure, which reduced near-term cash generation. Finally, interest coverage reached 35 times in 2025, up from 28 times in 2024. This means Amazon's operating income could cover its interest expenses 35 times over, compared to 28 times the year before. The improvement signals a stronger ability to service debt, even while investing aggressively in future growth. Overall, fiscal 2025 shows Amazon improving in profitability and debt resilience, but facing pressure on free cash flow due to its massive investment cycle. Looking ahead, Amazon stock could be supported by several powerful forces. The company's cloud division, AWS, is entering a new growth phase as it becomes the backbone of global artificial intelligence infrastructure. Massive investments in data centers and custom chips, combined with partnerships with leaders in the AI space, are expected to accelerate revenue growth and reinforce AWS as Amazon's most profitable engine. At the same time, Amazon's advertising business is expanding rapidly, transforming from a supporting segment into a major profit driver. With its unique reach across e-commerce and streaming platforms, advertising is now rivaling the scale of industry giants and delivering margins that outpace retail. Valuation also plays a role in the bullish outlook. Despite short-term volatility, Amazon's shares are trading at levels that analysts consider attractive, with consensus targets pointing to meaningful upside if the company executes on its growth strategy. Finally, the strength of Amazon's Prime ecosystem, now encompassing hundreds of millions of members worldwide, continues to anchor customer loyalty and recurring revenue. This combination of cloud leadership, advertising momentum, favorable valuation, and ecosystem resilience suggests that Amazon is well positioned to regain momentum and strengthen its stock performance in the years ahead. While Amazon's long-term ambitions are bold, several headwinds could pressure its stock in the near term. The most immediate concern is the company's unprecedented spending cycle. Management has announced a $200 billion capital expenditure plan for 2026, focused on AI infrastructure and cloud expansion. Investors worry that such aggressive spending will drain free cash flow, turning Amazon from a high-growth story into a capital-intensive utility. This fear has already sparked an 18% sell-off in February, erasing nearly $500 billion in market value. Regulatory challenges also loom large. The Federal Trade Commission's antitrust trial scheduled for October 2026 targets Amazon's marketplace practices, while European regulators have begun restricting algorithmic pricing. These legal battles create uncertainty around Amazon's core retail operations and could force changes that reduce profitability. Competition adds another layer of risk. In e-commerce, emerging players are chipping away at market share, while in cloud computing, Microsoft and Google are matching Amazon's AI investments dollar for dollar. If AWS growth slows or advertising momentum weakens, Amazon's ability to justify its spending spree will be questioned. Taken together, these catalysts, massive capital outlays, regulatory scrutiny, and intensifying competition, suggest that Amazon stock may continue to face volatility, even as its long-term strategy unfolds. Now we turn to Amazon's valuation, where its fair value is estimated at around $256 per share. On April 21, 2026, Amazon closed at $249.91, a level that suggests the stock is relatively undervalued. From a technical perspective, Amazon is trading above its 200-day simple moving average, signaling a bullish long-term trend. If external disruptions such as a Middle East conflict or a spike in inflation do not materialize, there is potential for Amazon stock to strengthen in the short term. This content is for educational purposes only and does not represent financial advice. Thank you for watching, and don't forget to like and subscribe for more insights.